All right, thanks for your patience there. Let's get stuck into it, shall we? Well, just before we do, just keep in mind that any advice contained in this presentation is general only. So it's not tailored to your personal circumstances, and you need to decide for yourself as to whether it's appropriate to you. So in today's webcast, what we're going to do is basically just, I would say it's more of a meeting of theoretical and practical. Right, so we're not going to just jump straight into the market, look at what's going on and try to find some trades. Certainly that'll be a component of it. First, I just want to run through who we are in case this is your first time joining us. I want to talk about what we think are, I guess, the core things you need to know in order to be a successful trader. And then we'll jump into it. Then we'll go through the market. We'll try to apply some live examples, maybe a couple of trading ideas using the type of strategies that we like to implement and teach here. And at the end, I'll go through briefly the trading course that we run, the education course, in case you guys want to learn basically how to do this through us. So again, if you haven't joined us before, we're Traders Circle, and basically we're a boutique trading company in Melbourne, right? We have clients interstate and we have international clients too. We've been open since about 2005, and we're a fairly small outfit. There's about 9 of us in the office. Our business model is more focused around, I guess, mutual success, client and staff retention. So I think the average level of experience in the room is probably about 10 years. I've been with the business, for example, for about 11 years and teaching and trading for about 9 of those years. So the idea is that we want to be able to build long-term relationships with our clients and build up a small trading community. We offer full service and online trading. So if you're someone who's not necessarily looking for education, but you want to be supported in your trading, then you're welcome to open up a trading account with us. We'll want to talk to you first, and we can give you some advice on your analysis, helping you manage your positions, executing orders, that type of thing as well. I mentioned earlier that we've been building up a trading community since 2005, and we interact with that community in 2 ways. Broadly speaking, every day from 12 o'clock to 1 o'clock, we run a live trading webinar. We didn't run one today because my colleague Sam, who runs his on a Thursday, is taking an extended break over Easter, so he's just off today and Tuesday. But typically from 12 o'clock to 1 o'clock, any market day, we would be recording a webcast where we go through the market as a group and we just look for trades. Anyone from our trading community can jump on that. It's there to kind of go through the stocks and look for any potential trade ideas. Each of the advisors has their own kind of twist to it. Like, for example, I run a webcast every Wednesday where mine's a little bit more swung towards education, because even though I'm an advisor and a trader myself, my skill set also lies in education content as well. We also run a message board where we post, sometimes we post important articles. We often post trade recommendations or trade ideas, things to look at, and market updates. So broadly speaking, we like to interact with our trading community in 2 broader ways. But on a one-on-one basis, we also help our clients manage their short-term positions. So a lot of my job, part of the reason why I was late to this webcast, was because we spend a lot of time giving advice to our short-term traders, people who we helped educate either recently or many years ago. We can help them with their analysis. So if they were looking at a particular trade and they wanted a short-term view on it, we could certainly help with that. We can help them price up different trading strategies. So we would be looking at things like different derivatives and different leverages, trading different market conditions, that type of thing. And I'll touch on that a little bit further into the webcast. And also executing orders. So, you know, if one of our clients wanted, like today, I helped close out a position for someone because they weren't in front of their computer and they wanted me to close it for them. So yeah, we basically, our goal is to be traders who support other traders. And it's something that we've been doing since 2005, where we've been building up that small trading community. It's just that a lot of people, perhaps some of you online, want to be able to learn how to trade properly first. And so we do offer that education as well. In terms of what we think you need to learn in order to be successful, is you can be pretty reductive and just boil it down to 3 main things: picking direction, strategy, and risk management. So picking direction is obviously important, right? Because you need to be able to speculate in the future direction of a stock, because if you can't do that, then, you know, obviously you're not going to be able to trade. We mainly focus on technical analysis, and I'll briefly run through that in a moment. Different strategies are important to be able to trade different market conditions because stocks don't just go up, right? They go down, they go sideways. And being able to have access to different types of leverage and being able to have access to different trading strategies that work for different market conditions means that you ultimately are able to have more trading opportunities and that you'll probably look at the market a little bit with a little bit less bias, right? If your only strategy is to make money when the stock goes up or buy low and sell high, to put it simply, then really the only thing you're looking for are bullish opportunities, and that can kind of color your vision a bit. Risk management as well is the kind of the final piece, because obviously you're going to get trades wrong. That's certainly part of trading. I guess you could say it's a cost of doing business. But you need to be able to survive that, and you need to be able to manage that both financially, but also from a psychology perspective as well. Okay. So those are the three main things that we think you need to be good at in order to be a successful trader. What brings them all together is a set of trading rules, and this kind of gets overlooked a little bit. I find when I'm talking to beginners, they really kind of underestimate how important some structure around your trading is. Trading rules are fantastic because they allow you to basically take everything that's out in the marketplace. So you've got technical analysis, you've got fundamental analysis, you've got obviously political commentary, you've got central banks doing things, oil prices, there's a lot of stuff going on out there, right? You need to be able to put it through almost like a meat grinder and process all that information through a set of trading rules that basically take all that information and it's turning into something that's actionable, right? Where you have some confidence in doing something. Now, trading rules help keep you disciplined, okay? As a beginner, that's what you need. I've always said that you don't necessarily need to be smart in order to trade, but you do need to be consistent and disciplined, right? And trading rules help you do that. They help reduce the stress around decision-making because it simplifies it, right? It makes things less emotional because you're ultimately going through a process that's meant to be logical and tested. Okay. Now, what your trading rules look like as a beginner to what they may look like after a couple of years of experience are going to be likely different, right? And the trading rules that you use might be different to another person. When we educate people, we give them a set of trading rules we use to find trades, and we'll teach you how to use them and we'll get you to practice them. But over time, as we continue to work with you, we're expecting you to evolve those trading rules to suit what your risk tolerances are, what strategies are working for you, and ultimately what your trading identity is. I mentioned there's two types of analysis, just in case some of you are very new. There's technical analysis and fundamental analysis. We as traders rely much more on technical analysis. It's basically the idea of reading charts, to put it simply, okay? It's about looking at past price data to try and predict future price movement, okay? There's different types of technical principles that we teach. I'll run through them in a moment. The other type of analysis is fundamental analysis, and we think that fundamentals, even though they're important, are much better suited for medium to longer term investing. See, the health of a company is important to its share price, but mainly in the longer term. There are obviously times where that's not true. For example, if a fundamental piece of data like an economic report comes out, an interest rate decision, let's say, or even around reporting season when you're looking at company balance sheets and their profit and loss and their future guidance, right? Those are types of triggering events that can certainly move the stock as well, or the market as a whole. But generally speaking, the balance sheet of a company doesn't really play into its stock price in the short term. Not really. We don't think so anyway. We think technical analysis is far more reliable for short-term analysis. So when it comes to trading rules, just getting back to the point, your trading rules should be structured in a way where the first part of it helps you pick direction. So we focus on technical principles like trend and bar analysis, support and resistance levels, technical patterns and indicators. Okay. Obviously, it can get much deeper than that, but holistically, that pretty much covers everything. Okay. Once you've got an idea as to where you think the stock is going, you need to be able to have a set of rules that help you choose the right strategy. Because we're not just trading stock, and again, I will go through this a little bit later on, you want to be able to have different strategies for trading different market conditions, and you want to be able to have access to leverage so things are less capital intensive, right? The problem with that is that it can get complicated quickly. And so having a set of trading rules will help, again, give you structure and help you plan out your trades better. And that brings me to the final point, which is planning and risk management. Before you even get into the trade, you should have a good idea as to where you're going to be closing for both a profit and a loss, right? So you need to be using technical analysis in conjunction with your risk management to make sure that you can close at an appropriate level to what the chart is showing you if the trade goes in your favor. So you have a target of profit. And also a defensive position where if the trade goes against you, you're looking to preserve your capital and to close out of the trade and just basically lick your wounds and move on with your life, right? So you need to be looking for exit signals and you need to be able to plan your trade effectively. And that also goes into capital management, right? For example, do you want to have 5 trades that are all on different miners? Do you think that's a good idea? The answer is probably not, right? Because you might be overexposed. It's different for everyone, but that's what I mean by capital and trade management to some degree. By the way, I forgot to do a bit of upkeep. If you've got any questions, you're welcome to type them in. I will try and answer them on the fly. If I miss them, I will address them at the end. But if you want me to repeat anything, this is an educational webcast as well. I'm very happy to repeat myself or go through something slowly, or reiterate it in a different way to help you understand it, okay? Don't feel like you're holding the group back. Now, I mentioned earlier, I threw around a couple of terms, and one thing that I think beginners struggle with is, or struggle might not be the right word, but certainly perhaps can be a little bit overwhelming, is the language, right? So I use the word leverage, and that's a term that can invoke fear. It should invoke a healthy respect. But leverage essentially allows you to use less money to make more money. But the flip side of it is that you can lose more money as well. Another way of saying that is that your profits and losses are quicker to generate, all right? It just ultimately means that you need to understand what you're doing. If I could use a quick analogy, and I'll try not to labor this too much, is that if you wanted to get from A to B, there's 2 ways, let's say, that you could do that. You could drive a car or you could walk there. Walking there is considered safer, right? You learn to walk as a child in theory, and you're probably not taking a large risk. If you fall over, you might graze your knee. Worse things can happen, obviously, but you would say that it's a fairly safe way from getting to A to B. You could also drive a car, but cars are significantly more complex. They're significantly more dangerous. You really need to understand what you're doing, right? Before you can even drive a car, you need to go get tested. You need to do a theoretical test. You're meant to have, your mum or your dad or someone in the car teaching how to do it first, and backseat driving and all that type of stuff before you can actually get on the road. But you will get to be quicker, right, in theory. So those are the analogy I like to use. You certainly can go slowly, but by wanting to trade and by utilizing leverage and utilizing different instruments and being active, being a trader, you're entering a higher risk environment because you're trying to generate higher returns. Okay, so it makes sense that you need to understand what you're doing. But look, getting back to the point, leverage is great, and having different access to different types of leverage, or levels of leverage, I should say, and having access to different strategies that allow you to trade different market conditions, we see as a huge benefit. All right. So there's 2 main derivatives that we like to trade. We trade warrants and options. Warrants are great for beginners. They're beginner friendly. They're very simple. There's very limited choices of leverage. We only trade things that have capped risk here. We don't allow any unlimited risk strategies, if you know what I'm talking about. Mini warrants have inbuilt stops. You can trade them from a bullish and bearish perspective. So if you thought that a stock was going to fall or an index was going to go down, then you could enter a position where you would make money off that fall, right? I hope that makes sense. It's not something that people are particularly familiar with. A lot of people think that that's shorting. It's not. It's probably, in my opinion, it's actually a much better way to profit than shorting from a bearish move. And again, it's very beginner friendly, even though it might look a bit spooky now. After spending some time with us, most people are confident trading warrants within the first month or 2 of being with us. Now, the other type of derivative we like to use are options. Options are the most flexible instrument you can trade on the market. They're exchange traded, so they're traded through the Australian market, which means they're regulated and they're transparent. They're not like binary options in that regard. These are, actually regulated. Now, options we typically don't teach to beginners. They're actually better suited towards intermediate and advanced traders. Beginners can learn it, but the problem is that it can distract them away from other things that are probably more important. So if you come and do education with us, the first thing that we'll actually get you to do is focus on technical analysis and risk management, right? We don't add options because we don't want to distract you away from those two core principles. Once you've practiced for a bit, then we'll introduce options. And the reason why we like options is because, again, they're the most flexible thing that you can trade. You can enter strategies where you profit from a bullish or bearish market, right? So you'll make money on two directions. If the stock goes up enough or down enough, right? You'll lose money if it goes sideways. You could enter a trade where you make money if the stock goes sideways or up, or sideways and down. There's completely sideways driven strategies as well. And I'm actually going to run through a couple of them today in the live market with you guys. But yeah, they offer the most amount of leverage as well. So you can really kind of get geared to the gills if you wanted to, or you can keep things relatively conservative. Okay. Options are great because they ultimately just provide you a level of flexibility that no other instrument can. It's just, once again, you need to know how to trade them effectively. All right. So you want to have rules about when and how to trade them. Okay. All right. So I'm going to jump off these slides and I'm going to go straight into the market now. Okay. If you've got any questions, once again, please type them in. I'm happy to address them. So this is what the software that we use looks like. I've got my watch list on the left-hand side. I've got some quote boxes further to the left there, and I've got my chart here. And this is aside for my, this is what I spend probably most of the time looking at. So if a client calls me up and says, I have a trade on Wesfarmers, what do you think of the stock? I'm in a bearish position. I'm in a put option. Do you think I should close it, right? Or what do you think of the stock? What's your opinion? I spend a lot of time looking at these charts and helping people with their analysis. What I want to do today is just run through some technical analysis principles and give you some structure around how to do technical analysis. You're obviously not going to learn everything in what I hope is a 1-hour webcast, obviously, right? But these principles are fairly universal, so you can Google them. It's just that it might take you a bit of time to kind of get good at it. The other thing to remember is that you do need to practice, and you want to make sure that you're picking up good habits early on, because if you spend a lot of time trying to teach yourself this stuff, you're much more prone to, in my opinion, losing money and picking up bad habits as well. So my chart looks pretty messy, huh? Right? I've got the actual stock here, or in this case, it's the index. I've got these orange squiggly lines on the outside called the Bollinger Bands. I've got a 50-day moving average, a 100-day moving average, a 200-day moving average. I've got the volume, and I've got a stochastic oscillator down the bottom here. Okay. You can add more indicators. Lord knows a lot of people do. Other popular ones, our software gives you all these different types. That shows you how many there are, right? And a lot of people use a lot of them. If you remember the slide that I had before, this little image here, right? It's meant to be a joke, but it's, people's charts can end up looking pretty messy, right? That's meant to be a bit of a tongue-in-cheek slide, but the reality is that technical analysis can get pretty hairy pretty quickly with all the technical indicators that you can overlay. We like to keep things relatively simple, right? It helps from an educating perspective, but it also helps keep the message clear. When you have too many indicators on your chart, you start to get an analysis paralysis because you'll have conflicting information. But that being said, I'm not going to discourage anyone from exploring technical analysis that works for them. This is what just works for us, okay? So when we're applying technical analysis, we typically have a structure where the first thing you want to look at is today's trading range, right? You want to see what the forces are today, okay? Once you've done that, you want to zoom out and you want to see if you can draw any trend lines in, okay? Zoom in, draw in more trend lines, try draw in your key levels of support and resistance that are near the share price, look at any technical patterns that might show itself, and then confirm with technical indicators, right? So we'll go through that process slowly. Again, I'm not going to labor each point too significantly because we'll run out of time, and I don't want to give all the milk away for free, if you know what I mean. But yeah, so we'll start with, for example, just drawing trend lines, right? It's a really good base. Trend analysis is, I would say, pretty much, the backbone of technical analysis. And you won't need to zoom out each time that you do it. If you want to go really far out, you can switch it from a daily chart to a monthly chart or a weekly chart, because that tends to help just condense the data a little bit more. When we're trading the short term, how the longer term trend looks isn't particularly important either, by the way. It's good to do, though. It's good to kind of keep an eye on things from a longer term perspective as well. But at the end of the day, it's not really going to help you make decisions on a daily basis, I don't think, anyway. So yeah, looking at a daily chart, you just want to zoom out and get a broader idea as to what the market's doing. And as you can see, we've been pretty much tracking sideways for the past 2 years, right? For example, the price that we're currently trading at, we were trading at in June 2021. Now, obviously, we've gone up, down, up, down, down, up, down, up, down, up, down. We've gone all over the place, right? But generally speaking, things have been tracking somewhat sideways. And our moving averages kind of help explain that as well. But yeah, it's kind of hard to say where the trend is, right? There's not really an uptrend in play for the longer term, unless you go the really long term. And in the medium term, it's kind of harder to say. We define trends by peaks and troughs. So you would argue that we're trading in a downtrend still, right? There's the peak, right? A lower trough, a lower peak, a lower trough, potentially a lower peak. We don't know. It could play out not to be that way. We don't know yet. But you would argue that in the medium term, there's a decent chance that we're actually trading in a downtrend. In the shorter term, you might say that we're trading in an uptrend, but trends, again, are defined by peaks and troughs. So a solid trend has higher peaks and higher troughs, like here, higher peak, higher trough, high peak, higher trough, high peak, higher trough, high peak, higher trough, higher peak, right? Here's a more categorized downtrend, lower trough, lower peak, lower trough, lower peak, lower trough, right? That's actually what categorizes trends. It's important you know that. This is fairly basic stuff, but it's important to know, right? You can't move on to calculus unless you know a basic arithmetic, right? So it's important to understand what the trend is, and it's important to call it out, right? Once you've got that idea, you can draw in your trend lines. Now, trend lines and trends are two different things, right? Trends are defined by their peaks and troughs, and trend lines try to connect the peaks or the troughs, okay? Now, I can't really draw a trend line that I'm particularly happy with, okay? And usually I would pick a better stock that's much prettier, but this is the broader market. This is, when someone says the Australian market, they should be talking about the XJO or the ASX 200. And I said today we would be going through the market and talking about it. So that's why we're doing the analysis. But typically I'd like to pick a much prettier stock where I can do much more clean analysis on, right? But unfortunately the XJO isn't like that. And it normally isn't like that either. So I can't really draw a downtrend line that I'm happy with, okay? It kind of cuts through. I'm not particularly happy with it. So I'm not going to have it there. I'm going to delete it. Equally, trend lines that have finished in the past, like that was a trend line there, right? That's no longer relevant. It's finished. It's history, right? So there's no point having that there. We don't want to clutter up our page with unnecessary lines if we don't need to. What you can do is you can potentially draw this. It's not going to help you make heaps of decisions. It does hit today's bar. It's not fantastic, but it kind of gives a visual representation to the upwards pressure, okay? Aside from that, I don't think there's really any other trend lines that I want to draw. Some people draw trends a little bit differently, like they'll smash it straight through the middle here. I tend not to do that. It's each to their own. I think that you should try and avoid going through price data when you can. So now that I've drawn my trend lines, and admittedly there is only this really kind of meek looking, meek's maybe not a strong word, but it's not a very valid trend line. The next step would be to try and draw any key levels of resistance and support. Now, this is where it gets really kind of hairy, because when the market tracks sideways for such a long period of time, you'll probably find with the XGO that there's a key level of resistance support every 50 points. Okay. For example, if I was to draw in a support level down here at 6,900, right, index points, and 7,000, right, you can see that the market consolidated within that range for a while there. Yeah, back down at the recent lows. You can see it was support level through here, right? It was a support level there, resistance level there. You can see it was resistance there, support through here. There was also support there, support throughout here, support down here, support there as well, and resist. Anyway, my point is that it's a very 6,900 to 7,000 is a very key level for our market. Okay, so is 6,950. I didn't draw 3 lines there because it clutters up the page, but it's somewhere around there, right? Equally, the top of the market seems to be roughly about 7,600, let's say. You can see we stuck our head above it here, created all-time highs there, stuck our head above it there. I know it's not a great, I know it's not zoomed in, stuck its head above it there, stuck its head above there, and then we got pretty close this time around here as well. So we'll call it 7,600 is the resistance or somewhere around there, right? This is speaking very broadly. This is obviously not like honing in and fine-tuning it, but my point is that the market, you're looking for levels that have played out both recently and historically. Getting back to the actual current market though, what's going on at the moment. For me, 7,200 and 7,250 are really important levels. One, 7,200 is a key support, and you can see it will support back here. It will support here as well. And if you go back and have a look at support more, I'm not going to waste the time doing that. And equally, 7,200 is an important level too. So sorry, 7,250. 7,250 is the recent consolidation range's resistance. It was resistance there and resistance there as well. So 7,200 to 7,250 for me is the sticking point at the moment. Our market is simply tracking sideways as we head into Easter. It's been grinding sideways for the past few days, kind of just waiting to see what the US does. I like to go and have a look at the S&P 500. I find the S&P 500 largely dictates what our market does. If it's not what it did last night, it's what it did last night in conjunction with how the futures are trading during our session. So you need to keep an eye on both, right? But the combination of the two ultimately dictate which way our market goes. But yeah, our market seems to be just tracking sideways and waiting to see what the S&P 500 does. And I think the selling today is purely just because we were at the top of the range, and also because people might want to just de-risk going into the 4-day weekend. Furthermore, our market is looking overbought in the short term in a couple of different, but I'll explain that in a moment. So once we've kind of drawn, you can, by the way, you can draw in more levels. You can draw them as many as you want. At some point, you're kind of just cluttering up the page, but 7150 I think is another level, and then up here at 7350 is another, right? Okay, if you wanted to say, well, if the consolidation range breaks, where can we see the next level of support? For me, that'd be 7150. And equally, if the consolidation range breaks to the upside, where's the next target of resistance, which is 7350. So the reason why we want to mark these levels is because if we see a break of the consolidation range, it'll be perhaps an opportunity to trade it, right? For example, if the consolidation range breaks to the downside, if I want to trade it, I need to know at what point do I need to close the position, and that'd be the next key level of support at 7150. And by the time the market breaks, am I going to be too close to that level to profit? Equally, if the consolidation range breaks to the top side, I need to be able to make money to 7350 because that's where I see the next level of resistance. And those words are very literal. They resist against the stock rising further. If you're in a bullish trade, you probably want to be out by the time the stock starts to hit resistance. Again, you need to be able to make sure you can make money there, but there's ways to do that, obviously. Once we've drawn in our trends, our counter trends, and we've drawn in our support and resistance levels, the next thing is to try and identify any technical patterns. I'm not going to spend a lot of time here. I'm just really going to move on. But there are things like reversal patterns, continuation patterns. There are things like triangle patterns, channels, that type of stuff, right? Beyond that, you want to confirm with your indicators. So things like your moving averages, I like to use. You can look at volume. It's not going to help you much in this circumstance. Your stochastic oscillators is another one, or your Bollinger Bands, right? Just as a quick note, as a quick indication, I mentioned earlier that the market was overbought in the short term, and these stochastics are set to very short-term parameters, and you can see they're right at the top there, and we call this little area up the top here the overbought area, right? Typically, when the stock gets to the overbought area, you can see that it crossed over here, which coincides with that day there. When they start coming off, the market is usually selling off, right? And then when it got down here, it was in the oversold area, right? It's tracking sideways in the oversold area. It starts to come out of the oversold, right? Because it starts to mean revert. And then once we start seeing the bullish movement, the stochastics start rising. So are they going to help you? Are they? Well, rather than phrasing it like that, the way I should say it is that things like the stochastics and the moving averages are meant to be looked at the end of your analysis. A lot of beginners use technical indicators as almost like a shortcut to their direction picking, and it's a pitfall. It's actually a trap. What you want to do is you want to go through the process of looking at entry signals. You want to look at trend analysis and support and resistance. You want to look at technical patterns, and then only at the end of your analysis do you want to confirm with technical indicators. Okay. So when I mentioned that the market's looking a bit overbought, it's largely because we've had a strong run up, and my stochastics are telling me that it's in the overbought. It doesn't tell me when the market's going to fall, but it tells me that there's pressure, right? Eventually, even if the market goes sideways, that pressure will ease, right? Because there will be consolidation, but we haven't seen that yet. We've only seen it for the past few days. Another one of the reasons why I thought the market would be down today. Okay. Yeah, so that's a quick lesson on technical analysis. I know I obviously didn't run through anything too deeply. I probably didn't teach you anything that you haven't seen before, I should at least say. But hopefully I gave you an idea as to structure, right, and the type of technical principles that you need to be learning. I'm going to come back to the XGO, but what I want to do now is just give you a couple of trade ideas, and I'm going to show you how to use how we use options. I can show you warrants as well, but we'll see if we've got the time. Warrants are much simpler. If you can do an options trade, then you'll handle warrants no problem. If options are what I go through now is a little bit confusing, we don't start beginners there anyway. That's a goal that you can have to get to, and we can get you there within, say, 4 months. But we won't, for the first couple of months, we won't even teach you what I'm about to go through. But I just want to show you kind of what's possible. And for those of you who can trade this stuff, just to give you a couple of trade ideas today, okay? So I'm going to come back to the XGO because I want to finish on it. I want to show you a trade idea on it. But first, let's go through CBA. Now, I think the banks are a little bit overdone. They reacted very poorly to the whole banking crisis in the US that was triggered by SVB, that was exacerbated by Credit Suisse and Deutsche Bank and a few other things over there, liquidity crisis, all that type of stuff, right? It was probably overplayed a little bit. And I think that, our banks are pretty secure, right? They have virtually a license to print money. They're highly profitable. They're incumbent and they dominate, right? SVB, by the way, was like America's 18th largest bank. Yeah. I mean, Commonwealth Bank is literally Australia's largest. So we aren't talking about the same thing here. Okay. All right. So you can see I've cleared my chart. I haven't got any lines on it. We can go through the same process of analysis. I'm not going to I'm running out of time, so I'm not going to do it slowly. I'm just going to do hopefully you can follow along. I respect my chart does look pretty messy, but you get used to it. What else? We don't need none of those. Now, whether or not you should trade this today is a tough one. I think that CBA is one that you could leave till Tuesday. But if you can get it on today, the time decay over the weekend will help. Let's go with that. And today's not the best entry. Today is not a good entry signal for it. But, you know, as rules go, I tend to be a little bit more relaxed on that one. So this is a CBA bull put that I actually did a couple of weeks ago. We got in for 40 credit. So we were given 40 cents when we entered the trade. It's now worth 7.5, which is what we would pay to close. Right, we would keep 32.5 cents. We times that by 25 contracts times, so we're up about. This is up about $800. The risk on the trade was $4,000, so that's not too bad. $800 divided by 4,000 is 20%. So we made 20% profit in about 2 weeks, which is pretty good, I think. But that's not the trade I wanted to focus on. That's just one. You know how I say every webcast I'd go through a Wednesday one? Every Wednesday I run through a webcast. This is just something that I've been kind of doing with my group over the last couple of weeks. Today we're just going to look at a different one on CBA. This is our calculator. The calculator allows us to build strategies, and they allow us to project so that we know when we're going to get out, roughly what our profit's going to be at particular prices at different times. So today we're doing a CBA bull call. All right. Again, today might not be the best day to do it. I'm not particularly confident, but I did want to show it to you anyway. And the strikes that I'm going to go with are 101 and 97.01 here, these ones. Okay, and I'm going to push out to May. All right, so without explaining how options work, because to be honest with you, it's not necessary and we can worry about that later. This is a strategy that we like to implement when we think the stock is going to go up to sideways. Okay, so if you think that looking at CBA's chart, you think it's going to recover, I think that it's reasonable to see it at 102. Albeit it might track sideways for some time. This is a strategy that we like to implement, okay? And we'll teach you how to set it up. We'll teach you when to use it, how to set it up, all that type of stuff, right? I'm not going to do that today, but you can see this is the basic setup. I'm not expecting you to understand what you're looking at here. I'm going to do 15 contracts. 15 contracts should put our risk at about 2.5. Yep, so it's about 2.5 grand here, okay? So the total risk on the trade is 2,565. And if I scroll down to the payoff matrix, what this payoff matrix does is it shows me how much profit I make at different price points over different periods of time. So that's today's date, right? The 6th of April, 2023, the 7th of April, 2023, the 8th of April, the 9th of April, the 10th of April. So you can see, once again, the y-axis goes from left to right, represents time, right? So it shows the next week. 98.59 is the current share price, or it pretty much should be, right? 98, okay, so it's off by 10 cents, but it doesn't matter. It's because this is delayed data. Price is delayed 20 minutes. So 98.59 is the current share price, according to the calculator. Give or take 10 cents, it doesn't matter. And if it goes up 1%, the share price will be 99.57. If the share price goes up 2%, it'll be $100.56. If the share price goes up 3%, it'll be $101.55. So these are 1% price increments higher and 1% price increments lower. So $93.66 is 5% lower than 98.59, okay? I know I'm just throwing numbers at you now, but the point is that what we're trying to do is project how much money do we make or how much money do we lose if the share price goes up a certain amount, down a certain amount, over a particular period of time, okay? So I'm just going to quickly refresh my page just in case. So I'm going to put this on 3-day time increments. So that's today's date, still the 6th of the 4th, but that's 3 days time, the 9th of the 4th, and then 3 days time after that, the 12th of the 4th, and then the 15th of the 4th, etc. Right? So I put it on 3-day time increments. Now, again, looking at this trade, you might be wondering what all these numbers mean. Well, they're pure profit and pure loss. So for example, I mentioned that I think the share price could get to about, let's say $102, okay, within a reasonable time. $102, or $101.50. You can see that if the share price gets to roughly, let's say $101.50, I'm going to make about $800, right? In 3 days' time, obviously the market won't be open, so we'll go 6 days' time, you'll make about $800. That's $800 profit. Okay, your risk is $2,500, but you'd make $800 profit, which is pretty good. 800 divided by 2,500 is about 32%. Okay. In 3 more days, you even make more money, and in 3 more days, you even make more. So this is, when it gets up to these levels, it's what you call time decay positive. So each day that you're staying in the trade, you're making a little bit more money. In the beginning, you can see it's fairly time decay neutral. You will lose money slowly over time, which is just the way the strategy's been set up. And if the trade goes against you, you'll lose money as well. So for example, you can see that I've drawn in a support level here at about, let's just call it $98 to be simplistic, right? I'll just draw it a little bit lower like there, okay? If the share price gets through 98 and you close the position, by the time you get out, you might lose about, let's say $600, something like that, by the time you get out. If you wanted to use a lower stop, if you wanted to use a stop that was down here at, let's say 97, then you'd have to be willing to lose about the same, right? $600 to $800, right? And you might be okay with that. You may not. If you're not okay with that, we can always change the strategy around, right? We can make the strategy more conservative by dropping it down. We can reduce your contracts. We can push it further out in time. I'm not expecting you to understand that, but hopefully you've got a rough idea as to what I'm saying about this payoff matrix, where if the share price goes up, this is how much profit you're making at different price points at different times. And if the stock goes against you, this is how much you're losing at different price points at different times, okay? It's a very, very, very handy tool to have. So I quite like this because, again, today's probably not the day to enter it. I like it because I can use 97 as a stop if I wanted to. So if the share price goes down and goes through that level, I'm probably going to be able to cap my loss at about $600, which I like, right? But if the share price goes up to my target, which is, let's say, like I said, about 101.50, if it gets up to 101.50, I'm still making a nice like $800. Okay, and that's good. Another trade that we could do today is that we could look at least is either mineral resources or BHP. Again, they're not the best entry signals today. It is what it is. The other thing is that you want to keep an eye on iron ore. Iron ore seems to be descending at the moment. Red is good, green is bad, because this is a Chinese chart. So they make red the good color and green the bad color. So like green means falling and red means going up. So you can see that it's been falling the last couple of days. It has edged higher today. It is down today, but it was trying to recover. So there's a bit of downward pressure on iron ore at the moment, which makes me kind of hesitate doing it, something on BHP or mineral resources. So rather than perhaps look at either of these, what I might do is just go straight back to the XGO and show you another trade, and then we can basically finish up there. So on the XGO, we use this calculator once again. So you can, by the way, you can write in your what the strategy is. So I might keep an eye on this one. We're getting in for $1.67.5. Okay. So now we're going to do an XGO trade. We're going to do a condor, and yeah, we're going to do a condor. Okay. Now, I'm just gonna enter this trade. And again, I'm not going to go through the process of why I'm choosing the things that I'm choosing, but I'm going to show you it, and I'm going to show you the payoff matrix, because at this stage, the point is not to really understand how it works or why it works. You just need to understand that it does, basically. Yeah. I have to give me a moment. So I'd say this is a bit more of an advanced strategy. Okay. Essentially, you want the market to stay between the pink lines. Okay. Actually, hang on a sec. I need to change these expiries. Yeah, I'm not getting the credit that I was earlier. I was getting, that was 3 credit before. Things have changed. All right, I'm just going to push out to the 20th. I'd probably rejig this now, but I haven't got the time. But for the context of education, it's fine. So I'm going to, what I said was you need the market. With this strategy, you want the market to stay between the pink lines, right? So in this case, it'd be 7,400 and 7,050. So let's go have a visual look at what that, let's go have a look at what that looks like visually, right? So on the chart, I'm going to make this a different color. I'm going to make it, I don't know, let's go electric pink, huh? And we'll make it dotted. So the idea of this strategy, and again, I'm not expecting you to understand why or how it works, right? We can always worry about that later. But the idea of the strategy is that you want the market, the current market, you want the market price to stay between 7,400, this line up here, and 7,050, this line down here, between now and the 20th of April. So for 2 weeks, literally 2 weeks exactly, 2 weeks in the morning on the 20th of April. Okay. You want the market to stay between this level up here and this level down here. What do you think the chances of the market staying between this level up here and this level down here between now and the 20th of April? You either, if you don't think that's a high chance, you don't do this trade. If you do think it's a high chance, then this trade is suitable. Right? This is why it comes down to what your directional view is. So 7,400 and 7,050, again, you want the market to stay between those 2 pink lines. I want to reiterate, it doesn't matter how or why this strategy works. You just need to understand that it does, okay? So we're getting about 10 credit, which means the risk on our trade is 40 points, okay? It just is, trust me. Each point represents 10 bucks, all right, $10 a point. Let's say you wanted to risk, I don't know, 4 grand, okay? I'm just picking a number, all right? 4,000 divided by 40 is obviously 100, and then we divide that by $10 a point, and that arrives us at 10 contracts. Okay, you can do that maths in your head. It's simple enough, but I thought I would go through it. So your risk on this trade is $4,000, and you're actually going to receive $1,000 up front. That's the most you can make from it. Again, this is weird stuff. I know if you're only used to trading stock, this stuff seems a bit foreign. But your risk on the trade is 4 grand. Your maximum profit is 1,000, and you make your maximum profit if the share price stays between this level here and this level here by expiry. There's no hidden fees. There's no hidden risk or anything like that, right? Your maximum that you can lose on this trade is 4 grand, and the most you can make on the trade is 1,000. Okay. All right. So by the way, I can prove it to you. This is the payoff matrix again. Notice how the numbers don't get better in 1,000. They don't get worse than 4,000. And I know it's 3,970, but the $30 difference still do you know what I mean? Because you can't actually get filled at 10.3. You can only get filled at whole numbers. So your risk is 4 grand. Doesn't get worse than 4. Doesn't matter what happens. Doesn't matter if the share price goes up to 8,600, or sorry, the index price goes to 8,600. Doesn't matter if the index price gets down to 5,700. The most you can lose is 4 grand. Equally, the numbers don't get any better than 1,000, right? So putting it back to something a little bit more realistic though, this is a strategy where you don't actually want, again, the stock to go up too much or down too much. Or in this case, it's the index. I keep saying stock, but it's the actual index. And again, provided the market stays below 7,400, you still make your maximum profit by expiry day, which is the 20th of April. And as long as it stays above 70.50, you still make your maximum profit of 1,000 by the 20th of April. Okay. So yeah, it's a trade where you don't have to think about whether or not the stock's going up or down. You just have to make sure that you pick a boundary that you think it's going to stay in. I like this strategy. I think you could enter this strategy today. I think that you would want to do it a little bit differently though. You've got to think about how much trading capital you have. Yeah, there's more to consider with this trade in the sense that how you manage it, you need to be effective because you need to have risk management systems in place so that if you do get threatened, you're able to roll the position. But yeah, I mean, this is probably one of the most advanced strategies we teach. You wouldn't be learning this in the first few months of being with us. It's something that we would introduce later on and get you to practice first. But it's a pretty good strategy. It's a strategy that probably the vast majority of our traders use on a regular basis. Any questions? So I think to wrap up, just so there's something for everyone, I think to wrap up, I think the materials you got to watch out for because they're somewhat in a bit of no man's land at the moment. But I think the financials are going to be a good buy soon. Right? I think that the index is set to move back towards 6,400, right? And I think that they're just kind of tracking sideways heading into Easter at the moment. In terms of trading ideas, I think that you'd probably want to leave the miners for now. I contemplated pricing up a strategy on them, but I'm not confident enough. I think that the banks, you could have a crack today, but you might want to wait for a better entry signal on Tuesday or Wednesday. And I quite like the this extra condor, right? But if you don't understand options, you've never traded them before, I honestly don't suggest you trade any option strategy until you've learned about them first. Okay. I did want to kind of go through warrants, but I think I'm pretty much running out of time. So I might finish up there. If you guys want to have a chat about anything, you're welcome to give me a call. What I'll just quickly do is just spend a couple of minutes just running through our education program, just give you a quick overview in case you guys are interested. So a lot of people go through this kind of learning journey where they obviously they research for a while, and then they learn how to trade properly, and then they obviously start trading. That's what we think the ideal journey is. A lot of people are kind of in this stage here where they're still researching. You're going to be tempted to go down a path of self-education, and to be honest with you, it's a good path to have in the beginning, especially if you're looking at longer-term investing. But you've got to be careful because if you try to go down a path of educating yourself for short-term trading, it's kind of like teaching yourself to drive. It's achievable, it's doable. The problem is that you just might wreck your car a few times, and you also might pick up bad habits, right? You might learn to drive with with one hand instead of 10 and 2, or you might not learn how to shift gears properly. You know what I mean? It's not a great analogy, but I think it's close enough. What you're better off probably doing, and I know it sounds self-serving, but you're probably better off coming getting a proper education and proper support so that you develop those good habits early on and that you're able to, I guess, learn in probably a safer and more progressive learning environment. All right. Our approach, we believe in face-to-face workshops, which can be done via live stream, as well as online learning. So we like to use a combination of both. We like to meet you in person. We like to kind of spend some time with you, right? We have a very strong emphasis on mentorship, right? We want to be able to kind of hold your hand and work with you one-on-one to help you practice first. We believe in teaching a very practical approach to education and give you some structure around what you're doing. And then once you've kind of gotten the core skills down pat, to help you refine them to suit you as an individual, basically. Okay. We run a 4-month course. We only run it 4 or 5 times a year. We only take in 10 students into each course. But basically, we focus on technical analysis, different trading strategies, and risk management. And the context in which we teach you all that is through a set of step-by-step trading rules. Okay. In order to do this course, you don't need any prior experience or knowledge. Okay. Often it can help if you don't, because people who come to us already with some years of experience, we have a harder time undoing those bad habits. In terms of structure, like I said, it's a 4-month course. There's 2 weekends where you have to be available for face-to-face education content. You can do it via live stream if you want to. That's often a better solution for our international or interstate clients. But if you'd like to make the trip down to Melbourne to attend the face-to-face instead of doing it via live stream, then we encourage that too. Even though there's 2 weekends of face-to-face education, there's actually 4 months of ongoing online training where you have access to our online learning portal. There's those daily webcasts I mentioned to you earlier, plus a whole bunch of training videos and other online resources, including trade recommendations and things like that. We'll run a couple of paper trading competitions between you and your classmates, right? Just to kind of get you to practice first. And you have your own dedicated trainer, okay? Your trainer is someone like myself, where they have years of experience both teaching and trading. A lot of their time, their job, if they're not helping to train people, is largely spent helping our clients manage their positions. So giving real advice on real trades, basically. They're there to answer all your questions, so you can call them as many times a day as you like. You're welcome to email them, set up Zoom appointments, or come into the office if that's what you'd like to do. They're basically there to help you practice and turn all that knowledge that you're learning into the course, from the course, into experience, okay? As a trader, you need to gather experience. You need to discover what your trading identity is, what your risk tolerances are, what styles suit you. The problem is you can't really start gaining effective experience until you learn how to do things properly, right? So your trainer's there to make sure that you're doing your analysis right and to make sure that you're following the rules correctly as well. Once you're ready, once you've proven to yourself on paper that you can turn a profit, your trainer's there to help you transition to live trading as well. And then essentially we just become your advisors. Okay, that's generally what our business model is. If you're interested in the course, the next one is coming up on the 6th and 7th of May and the 17th and 18th of June. So you would have to be available for both those weekends. Okay, that's the next course. The total investment for the course is $3,490. You can either pay that up front if you want, or you can spread it out over 3 payments over 3 months. And that includes the 2 weekend workshops that we run on the 6th and 7th of May and the 17th and 18th of June. Again, you'd have to be available for both those weekends, as well as 4 months access to our online learning portal, where you have access to all the technology we use, all the resources we have, as well as your own personal trainer, basically. And there's currently 4 spots left. If you're not really interested in education because you feel you're kind of up to date, but you just want some support in managing your positions, you're welcome to open up a trading account with us, and basically we can start helping you with your trading. It's completely up to you. Anyway, I appreciate you joining me today. I had a good time. Hope you did too. If you've got any questions, type them in now. Otherwise, I'll finish up there. And yeah, if you'd like some more information on our courses, just type in more info and I'll make sure to send you a brochure, and you can comb through some of the more finer details of the course in your own time. All right, guys, thanks very much for joining me today. I will catch you all next time. You're welcome to basically look this recording up on YouTube. I think it might be emailed to you anyway, but you can always find some of our other webcasts as well as some of our podcasts we run on our YouTube page. Okay, thanks, guys. Thanks for joining me today. Catch you later.